all of you. My name is Nelson, and I'm from.
Nelson, just 1 second. Let the recording start, please. Just one
Okay,
minute.
all
Huh?
right. So if you
Yeah.
can start. Okay.
Yeah. Now recording has started. You can start.
Okay. Hello, everyone. Very good evening to all of you. So my name is Nelson. I'm from Tradetron. I work as a quant, and today we have a very special guest, Mr. Vishal Varialani, who is a famed creator on Tradetron. And you would have already seen his strategies on the marketplace with the name of Strategy One Algos. So he has about just a brief introduction about Vishal sir. He has about 14 years of professional work experience, and he has worked in almost many top commodities trading firms of the world. Also, he has for the past 2 years he has been a full-time trader, and since he discovered Tradetron as a platform where he can also not only just create strategies for himself but also share those strategies with larger trading community. So that's when he decided to become a creator, and he has many profitable strategies on Tradetron marketplace. So today, this session is specifically about how to allocate your capital properly and how to be a profitable trader. Because sometimes what happens is that initially when retailers check a particular strategy, they simply deploy it without proper capital allocation, and sometimes when they face drawdown, they get disappointed and leave the strategy. So today, Vishal sir will actually explain how to allocate your portfolio properly across the strategies so that you can make proper investment decisions. Over to you, Vishal sir. Thank you.
Thanks a lot, Nelson, for the introduction. Uh, it was quite a brief introduction. Thanks for that. And I take this opportunity to start explaining first about what we are trying to talk about, and that's capital allocation. And then we will talk a bit more about strategy one. So when we talk about portfolios on algorithms, I think this is not a thing that a lot of people have heard about. And the idea is that we keep on looking into this as a business. So we are talking about running algorithms as a professional trader or a part-time trader as well. So it's a business that we are running. When we do this, basically we are going to be going through a few things. We'll first, answer why do we need a portfolio of algos. Then we will look into something like, what is the algo trading mindset. Then we go on to, how we can understand strategies beyond statistics. And then we will look into some of the tools that you can use to build portfolio. So when we look into this algo portfolio thing, like investing, systematic trading also needs to have a long-term view. And when you have a long-term view, you can gain from systematic trading, because systematic trading is not about predicting anything. It is about running a system day in and day out. It is not a discretionary thing that, okay, I will trade today, I will not trade today. It basically relies on a set of rules that we run every day, and those rules are supposed to give us returns in the long term. And that's what the basis of systematic trading or algorithmic trading is. And similar is the thing that we have with investing. When we talk about investing, we always talk about a long-term view in this, and that's where there's a parallel between algo trading and investing for us. When we do investing, we always look into diversification of sectors, and we always say, okay, we'll invest into banking, we'll invest into energy, we'll invest into media, we'll invest into commodities. Similar thing can be done with algos. We can diversify into a different set of indicators, different set of logics, different set of strategies. And we'll go on to this. What does this different strategies mean? In the coming slides. But that's the kind of diversification that we can do. We also can, diversify by allocating different capital to different sectors. In this is specifically what we do in investing. We will invest certain into banking, certain into let's say we'll invest into liquid funds, we'll invest into mutual funds. So this is how we will do a sectoral allocation. And similarly, we can also do a diversification of capital in algo. So they will have some into intraday, some into positional, some into buying. So this is again another set of diversification that can be done, like we do in investing. At the same time, in investing, we are always, Warren Buffett quote are given that, you should be staying during the downturn. And similar is the thing with algo trading. There will be drawdown, and all of us will have to face it, and we'll have to stay in that drawdown. That's very important. Looking at investments over a time, that's how you will look into returns over a period of time and not on a daily basis. Similarly, we have to look into a portfolio return of algo trading strategies over a period of time, be it a week, be it 1 month. It cannot be as long as an investment, of course it's not, but you have to look at it within a month, 2 months, 3 months. It cannot be that you just look into a day's return and say, okay, this is how I will go about it, or this is the strategy that will work for me. And last but not the least, when we do investing, we also have goals basis which we allocate. And similarly, in algorithms or in systems, we look into risk, and basis risk, we will determine our portfolio. Eventually, what we are trying to do is, portfolio is something that needs to be built to have a sustainable trading income. That's the mantra here. And with that, we come to the trading mindset, or algo system trading mindset. This is not a psychology lesson, that's something that we can do a bit later. But we are just trying to explain what should be the mindset of an algo trader, or what is the mindset of an algo trader. It is basically like nothing like just running a business. Either it is a full time. Someone like me I'm a full time trader, and someone else could be a part time trader. He just basically is running a system while he's having his full time job. He's just wanting to have an extra income. Anything that we are trying to get an income from, it's a business. And when you are running a good business will run every day. Doesn't matter that you are there or not. You might have some employees. If you are a shopkeeper, you might have an employee to run the shop, but it has to run every day. Either you run yourself or their employee runs it. That's the whole thing that can be differentiated, and that's something which Tradetron allows us to do. It allows you to run strategies with assistance of creators who know how to run the strategies. At the same time, we have to have a diversified set of products. Shopkeeper, again, I'm using a shopkeeper analogy because that's the simplest analogy that I can give. And I have. I can't get any simple than this. You cannot just keep vegetables. You have to keep groceries. You have to keep toiletries and everything. So you can't just keep one thing. If you keep one thing, then no one will come to your shop. And similarly, return will not come to you if you just keep one set of strategies. So portfolio of strategies is very, very important. Also, they have shopkeepers will have a product, different products have different margins. And similarly, we should have strategies of different types of risk. Some would be higher risk, some will be lower risk. A staple strategy would be something which will be lower risk. It will be intraday, it will be trading every day, it'll have smaller stop losses, it will have a smaller target, and that's how that strategy would work. And similarly, that happens with shopkeepers as well. They will not have everything at a 50% margin. They'll have something at a 5% margin as well. And that's what will attract people to come in, and that's what will attract the market to give us return. At the same time, the most important thing also for a business is to keep overheads minimum, and that's where reducing your brokerage charges come in, because algo trading as such, we have lots of trades and adjustments that happen, and reducing brokerage charges is very important. This is something that all of you know, and I don't need to talk about, but we need to be cognizant of that fact. Last but not the least, a shopkeeper always tries to control his wastages, and that's where we have to control our, stop losses. With our stop losses, we cannot be having running systems without stop losses, and we have to control. That's where systematic trading again comes in, because we have a fixed stop loss. Basically, again, a successful business is built by a driver's portfolio of products or algorithms in this sense. Now let's start looking at strategies beyond stats. So we always look into strategies, and this is something that has come to us. Many people will start with looking at strategies, and they'll say, okay, which is the best strategy you have? Which is the best strategy? How is it? And that and that. They always look into returns, but strategies are beyond returns. Unfortunately, people get blinded by returns, and that's where we have to understand not all algorithms are same. The P&L will reveal, how, it has performed over a period of time, but not on a day-to-day basis, how it performs. And that's where the psychology plays in. We have to understand that there are few segments. There are non-directional algorithms, semi-directional and directional, and they are intraday or positional. So what is a non-directional? A non-directional algo will always have a call or a put sold together or bought together. So if it's option selling algo, it'll sell everything together, call and put for the same instrument. It could be at the same strike, it could be a spread, it could be or basically a strangle, it could be anything. A semi-directional another case would be something that will start with a paired strategy or basically a call and a put sell both. But eventually, this is the market movements, it will change the direction and it will square off one leg, either selling or buying again. Last is the directional part where we are talking about predicting the direction of the market and then placing a position accordingly. Now there are other parts as well that someone would say there's an arbitrage system that will be there. There'll be a fixed income system basis a call selling basis your physical position and covered call selling. Those kind of things are there, but mostly they are not on Tradetron, and we are not having much let's say exposure to this for our clients as well. So we're just talking about majority of the strategies that you will see on Tradetron. They will be either non-directional, semi-directional, or directional, and they will be either intraday or positional. So now there is a comparison that we have. There are two strategies, strategy A and B. Someone who looks into this strategy A will say, okay, it's very good returns, and it has got a very less number of trades, while the strategy B has got a higher number of trades but has got less return. Capital is the same. It has been appropriated to make it the same. We don't have a so strategy A is X amount. So we have just appropriated to the same capital. But when we look into it, when we look into the exact stats, so we have 8 negative days in A, while 3 negative days in B. And if you look at the success ratio, the ratio is very different. There's a 85% success ratio in B, and there's a 62% success ratio in A. Now this is coming from live data. This is live data of a couple of strategies for the month of November that we are taking. Now you look into more data. Now everything will change. A strategy with a higher variation of P&L is the strategy A, although it has less number of trades, because it is a different kind of a strategy. It is a directional strategy. And this is how both of the graphs are looking. Now, someone might enter a directional strategy at a peak, which is basically 19,000. That was the peak of that strategy. And he said that I have lost money. But someone who entered at the start of the month, for him, is almost the same. And that's where, again, timing in terms of market might differ always. But when you have a portfolio, it will not affect you that much. That the drawdown that has come in, a 25% historical drawdown it has got, or the drawdown from 4,000 rupees drawdown on 1.8 lakh rupees. That drawdown would not have come to that person if they had started at the start of the month. But when you look into, this is practically every day this happens. People will generally join strategies when they came at the start of the, at when the strategy is doing very, very well. But we cannot predict when the strategy will fall. And that's where, a portfolio comes in when, the power of combining a couple of strategies together. And the next slide shows exactly the same thing. So A and B have been added in a ratio of 1:3. So A is the direction strategy, B is the semi-directional strategy, and so they've been added in a ratio of 1:3. And just look at the combination right now. The max historical drawdown has reduced to 3%. And just because that they have been complementing each other, expectancy ratio has increased. Although the number of positive days has decreased compared to B alone, the overall, let's say the P&L has become much more, attractive in that sense. Now, this is the data for 1 month. This can change. The idea is that we are just trying to show that what a combination can do. It can reduce your peaks and valleys in an equity curve, and it can stabilize your returns. There's nothing like a strategy that will work in each and every type of market. A strategy which is shown here, a strategy we might look that it's working in every market, but that's basically because of it being an intraday strategy working in a market which has been very kind to non-directionals. November was very kind for non-directional option selling as such. But it, again, this strategy is also prone to have peaks and valleys. It's up to us to understand the risk, put it as part of the portfolio, and then run it. So with all this, now let's talk about how to build a portfolio. We'll talk about 5 things: capital allocation, and position sizing, correlation analysis. That's something that we use extensively in our portfolio building or combo building, and we keep on analyzing this thing for our new strategies, old strategies, everything. How to manage drawdowns, shuffling of strategies, and a sample example with sample data of how we can do it, how we can create a portfolio. So capital allocation and position sizing. Now, primarily, we have a different person. All of us have a different personality. This personality is something that we discover while we are trading, and trading is a very fantastic, profession to understand your own self. Not everyone is able to understand themselves unless they start trading. That's my view, and something that I've carried from my professional experience. Because as traders, when you are under pressure, how you react is basically something that defines your personality in total. So it requires us to trade, and that's the first and the foremost thing. It requires us to understand our risks, what we are able to take as a risk, and whatever we are able to take as a risk. Eventually, the point is that's what we need to measure. So we need to start looking at ourselves as the maximum risk that we can take, and that's the MDD risk that we talk about. And this is a way of classification that we have given. It's not a golden rule or anything, but this is how we have classified after analyzing a lot of other traders. And again, our professional experience has helped us to understand these kind of types of traders that are there. So we've got a conservative type, we've got a very conservative type, mild aggressive, aggressive, very aggressive, and mostly directional. All these traders are defined by their max drawdown risk. And accordingly, we have a suggested allocation in terms of what position sizing they should have between intraday selling, positional selling, and buying. Uh, I think most of you are aware and should be aware that buying is quite risky, because it's a leverage form of trading, and not everyone is able to be successful in buying. So we have to be limiting ourselves into that part as well. So we're talking about selling and buying both, but not everyone should do buying. Although the capital required is much less, but the risk of losing capital is much higher in buying. So we define ourselves by the max drawdown risk. It ranges from -5% to can go to 30-40%. Yes, we know there've been a lot of traders on Twitter that have been talking about 70% drawdown. It happens in a directional setup. A directional setup will have this kind of a drawdown. Just one move can take away 10 to 20% of your spread margin that you have blocked against a trade. So this is something that is risky. Directional is something that is very risky. Positional strategies which are very risky. Everyone should understand the risk, and after that only they should allocate into different kind of strategies. So if someone is saying that I can't afford to have a 30 to 40% drawdown, they should not have a positional selling allocation or a buying allocation to their portfolio. If they can afford a 10 to 12% drawdown, which I think most of the people will be between 5 to 10% of a drawdown that they can afford, then your positional allocation should not be more than 25%. It can be as low as 10%, 15%, and 25%. Something that you need to discover yourself, or talk to some people that can help you design your portfolio, which we can do. I mean, that's a different thing that we'll talk about later. But the whole point is that you have to look into it from this point, that your positional allocation should not be more than 20%. Even if you're losing 10% on that 20%, right? For your entire portfolio, it will not be more than 2% in a single day. And that's what you do, and that's what that's the whole thing about position sizing. we limit our positional exposure. That's the bottom line. Intraday selling allocation is something that we have to use more judiciously, and we need to be more intraday focused if we are looking at limiting our drawdown. There's nothing else that will limit our drawdown except looking at intraday. So someone who's very conservative, he should not even look into position selling. If he wants, he can do zero position selling. He can only do intraday selling. And this might actually be something that will be different. Even someone might be having 10 lakhs portfolio size, but he's very aggressive. But someone might be having 1 CR portfolio size. He's very conservative. So it's not capital dependent. It is actually dependent upon how you are as a person, how you are as a trader. This is a very, very important point that I wanted to emphasize on. So we have to understand that thing and define our risk, and then we start the process of allocating capital and doing position sizing. When we do this, we use one of the tools that are available, which is a correlation analysis. Statistically, correlation is basically similarity between two data sets. So we are comparing two data sets of two strategies. It's a binary comparison. It says 1 or 0. So if both the strategies have made profit on the same day, it will say 0. If they have made loss, on one has made loss, one has made profit, it'll say 1. So it is not an entirely thing. You have to look into along with the returns as well, along with the drawdowns as well. But this is a start. This is a start that you can do, because everything else people look into. People look into returns. They will look into the drawdown, but they will not look into this correlation aspect. So what a high correlation means, that outcomes will be similar. So they will perform similarly in different similar market situations. While a low correlation means that the outcomes will be dissimilar. And then there is an extreme correlation of a 100% or a minus 100%, which basically means that they are opposite of each other or the same strategy itself. And then there is a correlation range, which is ideal, minus 40% to plus 40%. The correlation between a buying strategy or a directional strategy and a non-directional strategy will be mostly negative, because both are kind of opposite in one sense. Non-directional doesn't work when directional works. So that's where the negative number comes from. Ideally, the correlation is driven from different kind of setups, indicators, and instruments that we use as creators. So it is not just a number that is there. Number is a start, and then we look into other aspects as well. So this is a correlation of our portfolio of strategies. Quite an extensive list, of strategies that we have got, and we'll expand on this later. But if you see, some of the strategies that start from Z and G, they are directional strategies, and they will have, if you just go through across, this, this line, 100%. So it's basically zip and zip 100% is basically completely correlated. So it's the same strategy. And then you see something like TDS and zip. Then there's a negative correlation, because TDS is a non-directional strategy, while zip is a directional strategy. So that's where the number comes from. Now let's look into this and understand this. Zip is primarily a combination of a zip Nifty and a zip Bank Nifty. So zip Nifty and zip is 85%. So someone who wants to diversify, if they add zip Nifty and zip, they will get similar result. They will not get diversification. Similarly, when they do zip and zip Bank Nifty, because zip Bank Nifty is also part of zip, it'll have again a higher correlation. At the same time, when they do zip and GOS, GOS is a buying algorithm. So the correlation is much less. And that's how, it shows that, okay, even if it is buying, it's a different set of instrument. It has a different set of indicators. And that's how the correlation is lower. Similarly, when we see something like ZIP and TDS, we saw it again. It's a non-direction strategy. So, and ZIP is a direction strategy. So there's a negative correlation. While ZIP and TDD is a semi-directional strategy. So it has a slightly positive correlation. When we look into some strategies that start with T, which are all intraday strategies, between them, the correlation is going to be very, very high or higher. So TDS to TDD is 37%. TDS to TIDM is 45%. TDS to TMS is 55%. That's how the correlation is basically coming in. So if the number is higher, so how we read it is that if the correlation is less than 20, they will they'll be good for diversification. 40 to minus 40 is ideal. But if you want to see from a diversification point of view, a good diversification, 20 less than 20 is good. More than 20, they will perform very similar. And that's something that we would want to avoid. So we will not couple a zip with a zip nifty or a TDS with a something like a TDB, which is a part of TDS, unless it becomes part of a portfolio where there's enough diversification, and that's the second part that comes in. So what we want to choose is lowly correlated, not exactly opposite. So when you see something like a this zip BNF and TDS is exactly opposite. So most of the times zip this it will be zip BNF will be profits, TDS will be in losses. Something that happened today as well. So something that, we need to always be careful about. All this data is based on live auto of our strategies. This is regularly updated. We'll share, a link to this data as well. You can also understand it. Correlation is a very simple concept. You can all, check from Google and you'll be able to understand how to get this data for yourself for the strategies that you're using, and something that can be done. We are not comparing with other creators. It will not be ethical to compare with anyone else, because we also don't know how the data is coming from, and what is the basis of the strategies and what are the indicators. So we can't do that. But for our strategies, we know what works, what doesn't work. Next we talk about managing drawdowns. So we talked about doing the correlation analysis, but what about drawdowns? Drawdowns are supposed to come. How will we manage them? We first need to accept that drawdowns are a regular part of trading. This is a process that will keep on happening. We will get into drawdowns, but there are things that we can do to avoid drawdown, or avoid certain things that happened in drawdown. So one of the things is over trading, or over leveraging, or revenge trading. Let's understand what a drawdown is. Drawdown is basically when a system is outside a standard deviation. System is supposed to be successful 70% of the times, but it is not being successful 70% of the time in that period. In that period, that success rate might go down to 30%, 40% instead of 70%. But that doesn't mean that over a period of time, it cannot recoup, because it will happen that it will have streaks of performance. Like one of the strategies that we saw, it had an 85% success rate for that month, but historical success rate was 70%. When it was in a drawdown, it was having a 60% success rate. When it is out of a drawdown, it is having a higher success rate. We also need to look into understand one thing, that when we are in drawdown, the repeated SLs will occur. As we talked about the success rate being lower, this is coming because SLs are hit many times in system trading, and that's what defines system trading. We will accept the SL. We have to accept the SL, move on, and that's how we run our systems. We also need to understand more the trades that we do, more are the chances of failure in that kind of a situation. So a lot of people will say, okay, my stop loss is hit, but I'm going to reactivate because I think the market will move. We are forgetting that we have signed up to the system with the backtest that we saw earlier, or the backtest that we have seen, or the past results that we have seen, which are not basis these manual activations, reactivations, or over trading. So when we do that, we are actually saying to our previous studies that we did, or the previous results that have been shown by the strategy, as that your logic, the logic was not good. I'm smarter than the logic, which is reverse of system trading. System trading is trusting the system, not questioning the system. So that's something that we should always avoid, when we are in drawdown. Not looking for trading mode, not looking for doing something which will, doing a manual action on a trading system while it has exited. It has exited for the day, but okay, today's still expiry. Let's reactivate it, and then the gamma effect comes in, and then it gives further drawdown. So these are things that we have to be careful about and not do while we are in drawdown. Definitely not do while we are in drawdown. Another thing that a lot of people talk about is increasing or decreasing multipliers. Now, Someone would say, okay, this is the system. It has shown that it has gone to a 5% drawdown or a 10% drawdown. Why don't I increase the allocation right now? Past drawdown and past return is something that can never be committed or predicted. We never know when a system can go into further drawdown or the returns can extend further. We only know one thing, that we need to control our risk. So increasing allocation basis, this thought that I want to benefit from the drawdown that has come in, that might not work for everyone. That actually entails getting into more risk. You're actually trying to override the system, override your allocation. We talked about allocation earlier. We're trying to override the allocation by just this assumption that it is in drawdown and it will come out of drawdown. Similarly, it comes in when we decrease the allocation in during the drawdown. It is not advisable to reduce because the time taken to recover from the drawdown will be much, much higher. Because you have reduced the allocation from 20% to 10% now. Now you have to recover for the 10% and another 10%. So, if your recovery is going to be, if your drawdown was 5% and you have to recover 6% to come back, you will have to do it 12%, not 6%. And it'll take your drawdown time, it'll increase your drawdown time. So am I saying that we should not be, taking care of our stop losses? No. We have to start first from our allocation. Our allocation has to be right. If our allocation is right, 10% drawdown on a position strategy will not hurt us more than 2%. If our allocation is right, a 40% drawdown on a position strategy will not even hurt us more than 5%. That is how our allocation can be. I personally have a quite a aggressive allocation, and people who know me and have seen me trading, I have a 30% directional allocation, but my drawdown has not even gone beyond 3.5%. So that's how I'm managing my portfolio, and I'm sure all of you can manage as well. One of the things that we also need to check with ourselves is the drawdown pinching us? If a drawdown in a particular strategy is pinching us across our portfolio, we don't have the right kind of allocation. That's something that we need to first and the foremost thing for us to correct. We can't be having an allocation which is something that we don't have comfort with. It's just like, asking a dancer to start singing again in the middle of a performance. He can't. He's supposed to dance. Someone else is supposed to sing. That's how it is. Like KL Rahul was asked to keep wickets, but he is not a keeper. So that's again something that we have to avoid. We cannot be in a situation where drawdown is pinching us because of not having the right capital allocation. Having said that, there will always be chances and opportunities for us to shuffle strategies. But let's come up with a very important disclaimer here before we talk about switching of strategies. Frequent switching of strategies will never yield us positive results. When we talk about switching of strategies, what happens generally is where people look, okay, today something did not work, what did work? And then we start chasing that. And that's something which never works, that you start switching strategies. So you're switching on the day of the drawdown to a strategy which has performed better on that day. Next day might be the strategy will underperform while someone else has performed. So that's not how we should switch strategies. And unfortunately, that's how people start switching strategies as well. Once there is an outlier in the system, which is basically a drawdown or a negative result, because when we are making systems, we are making profitable systems. The drawdown or negative results are outliers. An outlier doesn't change the characteristics of the system. So we need to understand that it's an outlier. It will happen. It is statistically proven to happen. It doesn't mean that strategy is bad. It means that, okay, it did not work today. And we need to have a combination of strategies which will work most of the days for us. And and one of the things again that happens is most of the times when people keep on switching, it'll end up into more drawdown. When do we change or switch the strategies? It is basically on correlation data. So this is how we do it. Of course, it's a scientific approach. We are looking at data just as the data it is. What we look into is, has the correlation changed of the strategies in the last 1 month, last 2 months? And that can happen because of the market situations. And then we suggest a portfolio change or change in portfolio. So it is not basis what is working today. It is basis what is more, accustomed to that, the combination we have. What can stabilize the combination rather than what is working more. So it might be underperforming strategy is still part of the combination because it is still, balancing out one of the odd days. Like today was another day where none of the non-direction strategies worked, but something like a direction strategy worked very well. So in a portfolio, you need to, if you are having that kind of a risk appetite, you need to have a direction strategy which will counter some of those days and still give you a flat P&L. And that's how we design these switch off strategies or switch off strategies on correlation data. What how you should look into it as a user is, if there are strategies that you have which are failing together over a period of time, then you certainly need to manage your portfolio to you reduce the correlation between those strategies. And that's how you can start looking at it. So if something has not been performing, or some combination has not been performing for extended period of time, and that means that there's a correlation issue with them, then you should start looking at changing of the strategies or switching of the strategies. Another thing that we should do, see, I mean, we have been testing systems, we all have systems. We have a max drawdown defined in the system as well. And backtests sometimes don't reflect everything that can happen in future as well. So we have a rule internally, and we keep on telling that to our users as well. If a system has breached a maximum historical drawdown by 1.5 times of it, that's when we stopped trading the strategy. We stop trading the strategy, we let the strategy recover the drawdown, and then we switch back to the same strategy. We all have options. We have multiple options of strategies, be it directionals, non-directionals. We just need to make sure that we are not caught up in a soup where the strategy is going into uncharted territory. 1.5% of the drawdown can always happen because backtest is basis certain historical data, which is 1 minute data, and slippage is not considered many of times. And market also tends to be very volatile these days. Even with low wicks, moves are very, very high, and that's where that number we have to keep. And it is also best to keep that number in mind for the overall strategy. You might enter at a peak high, but if the overall strategy is in drawdown, you have to look into that number rather than also looking at, okay, when did I enter? Because most of the times people end up entering, although this is the truth, I can't be more open or clear with that. People will enter into strategies when they see consistent performance, and that is also one of the days, or it's more likely that the strategy will undergo drawdown. That doesn't mean that I am asking people to enter during drawdown. I'm asking people to make sure that their portfolio is allocated in such a way, even if a drawdown comes in, they will not have issues, or you will not have issues. That's the point. So it's not saying that we should get into a drawdown or enter into a strategy when it is a drawdown. When there is a strategy that comes under this max drawdown, one of the things that we can do is replacing with the same kind of strategy. So if it is an intraday non-directional that is under a drawdown, then we replace it with another intraday non-directional, rather than saying I will go directional now because the market has become directional. That is not how a portfolio can be allocated, because you are again increasing your risk with that. So that basically is the tool to shuffle strategies. Last is an Excel that we have. We'll share the link post this call as well. Um, there is when we talk about there's a combo that we have. Now this combo is of 9.6 lakh rupees, and then what we're saying that if it is deployed across this particular combination, there is a weekly ROI that is there, average monthly ROI that is there, and there's a historical DD that is there. What we suggest to people is that build in the DD into your capital, keep an extra buffer. What that does is, even if the DD comes in, you will not be short of margin. And one of the worst things that can happen is you not being able to take a trade while that trade turns out to be successful, just because you reached a DD and the capital was less. So that's why you should always have extra capital in your account, and that will change across the strategy. So if whatever DD percentage it is, the moment you add the DD percentage, the calculation will change completely, and you will have a total capital, and then you will have capital remaining. So it should, of course, capital remaining should be positive or zero. So that's something that you can look into. And then your allocation is decided by these formulas as well. We also have a link. You can go to that link. I'll show that link just in just a second, where we can look into what is the our performance of the strategy. We compare it on week versus the monthly average monthly return, and then we can take a look into how is it performing since we deployed it. So that tool is available for everyone. Anyone can download it, copy that sheet, and they can start using it. I'll try and see if I can share it right away. If yeah, okay. So I'm trying to share this window. Okay, right. This is the sheet that I'm talking about. On this sheet, you can just put up your the name of the strategy, whatever it is. Just put the ROI that is there, or take the ROI from the cumulative ROI and the start date, and you will get the average ROI. You will get the weekly ROI. You need to put in the last month ROI and the drawdown, and then you can start comparing it with your date of deployment and everything. And then basis DD, you'll get an alert on this sheet. Is it under control or not? If it is under control, then you need not worry. But if it is not, then you need to start looking at the data and design your own portfolio and help get help in designing the portfolio. Then we have also put up some suggestions to people. We believe that up to 2 lakhs, no one should do any FNO. Yes, there are people who want to do buying and 10,000, 20,000. That's not ideal, because some of the people don't understand that buying will have so much risk. When option selling you talk about, minimum 2 lakh capital is what you need, unless you have a leverage strategy when you're trying to leverage. So that's something which you also need to look into. If are we leveraging by taking extra hedges, OTM hedges, and the capital of the strategy is determined by that. So if a strategy has got extra leverage, it'll also have extra drawdown. Same strategy, which is you can see here, a TDD with OTM hedges, it will require a capital of 2 lakh rupees, and that's where the drawdown will increase. So drawdown will increase, ROI also will increase. So that's something that we need to be aware of. These are certain rules that we have, just guiding rules. This is the basis which we advise people to deploy strategies. And from the earlier drawdown risk allocation, we are basically explaining what should be your allocation across selling or positional selling or buying. uh, this is basically in Excel. You can always download this and you will get more of this. I'll come back to the presentation. And are you guys able to see the presentation? So yes, yeah. So this is how it is. Last but not the least, we'll talk about what strategy one is. You can find us on Tradetron. Our strategies are listed on Tradetron. We are a team of 7 with a combined experience of more than 25 years across different markets. We've got a professional experience of trading commodities, managing assets and finances across multinational companies. So my experience, was already talked about. And then I've got a team along with me who's handling this as well. We've been on Tradetron for more than 1.5 years as users and about 1 year as creator. So we've been creating strategies for over 1 year. We have a AUM of 30 CR plus 400 active deployments on Tradetron across strategies and different basket of instruments. We have more than 20 lowly correlated strategies. We talked about those strategies, and you can see them on Tradetron. There's a link, that is there to see our strategies. We are available on Twitter. I am available on Twitter. We have a community on Telegram, and we also have a website. With that, we can open up the Q&A.
Thank you, Vishal sir, for a wonderful presentation and all the detailed explanation of how to manage one's portfolio. Hello, everyone. If you have any questions, you can type it out in the chat section, and Vishal sir will be happy to answer those.
Thanks, Nelson. I've also been reading the messages. I think we will have the recording, right, Nelson?
You have been recording it, right, sir? If I'm
Yeah,
not
yeah,
wrong.
yeah. Yeah, yeah, I have
Yeah.
been recording. So you
So,
will be sharing
yes.
the recording, right?
Yes. So we will be
Yeah,
uploading it on our YouTube channel, so we can connect later on after this session, and we will do
sure,
that.
sure. How much capital would you suggest for a balanced portfolio? Okay, so it basically depends upon an individual what kind of balance they are looking in. If you are looking into an intraday strategies only, and you say I want to balance with intraday strategies, you can start with 10 lakhs, and that will be the ideal sweet spot between a couple of as we talked about the three strategies that we had, uh, that you can look into that. Okay. So yeah, so the balanced portfolio will be 10 lakhs if you're looking into intraday. If you're looking into position as well, it should go to 15 lakhs so that you are able to handle the drawdowns that come in along with position. Kabir Khanna is asking if we want to start using your strategies and diversify properly, will your team provide support? Definitely, this is what we do to all our subscribers, and the whole idea was that we talk about this thing to a broader Tradetron community. So even if you're not using our strategies, you should understand how to diversify. That's the whole objective of this. So if you want our help as well, we will come aboard. But the whole idea of this presentation was that you should be able to help yourself. But definitely we are there to help. Nitin Bhardwaj, do strategy one design portfolios? Yes, we have quite a bit of portfolios that are designed specific to the need of the clients, and we explain to them what a portfolio will entail. We stimulate it for them. They can see the portfolio performing for a period of time and how that will affect or the P&L fluctuations that it will have. So we do that. Yes, but of course only for our own strategies. Jignesh Shah said that he missed the beginning and he was confused. So, we will be sharing the recording. Anubrata Ray, mildly aggressive with a mix of positions. So we will basically come back to, we'll try to individually reach out to you and explain to you how that can be done. But ideally 15 lakhs is something that will be ideal. Vikram, the correlation. So Vikram is asking if the correlation is based on historical data only or some other factors. So it is based on live data of our strategies since they have been live. So it's not like based on a only on back test. So basis back test is what we validate our strategies to be different from each other. But when we compare this, we are only looking at live data, including slippages, including let's say if there is a certain thing that happens on a there's a spike that happens which might not be captured by a backtest, but it has been captured by all the strategies while they were trading. So we look into it from a live historical data rather than a paper trade or a backtest data. Saurabh, you were looking at Saurabh is saying that he's looking at the Super 3 portfolio. He's saying that three are uncorrelated strategies, but I saw the past data that two strategies hit max SL on a few occasions. Can you please provide input on the same? Now, very good question, Saurabh. This is so the idea is to look into a combination that will work across a period of time, not a couple. See, it may happen that on a certain day both of the strategies did not work. Only way to counter that is to make a strategy which is 100% uncorrelated. Then there'll be a zero sum game. You are only paying brokerages. So there'll be a certain amount of correlation. Some of the times both of the strategies will fail together. They will be successful together. But what we are seeing is how they balance each other. That is the more important point into looking into it. It may be that there's a slight profit in one strategy and a slight loss in some strategy. That is, that might happen. But still, the essence is that we are diversifying so in a way that over a period of time they will have different set of results and combined results will be much better in terms of reducing drawdown. Anubrata is asking, does the video cover how to read the present correlation sheet So yes, it does cover that. We are basically giving an example of how do we go from one to another, and then we can go across that. Which is your personal favorite strategy or a combo so far? Anubrita is basically asking is as if who's my favorite child. I don't have any answer to it. It works for me in a particular combination. I have all the strategies deployed in a particular combination, and across our team we have people who are deploying certain strategies as per their capital and risk appetite. That is how we are different as a team. We have got 7 people with 7 different ideas. They are running their own portfolio because everyone's assessment of risk, everyone's understanding of risk, everyone's type of trader is very, very different. So I can't answer that, straight. Devinder is asking, how do we get in touch with you? So Devinder, I have got my contact details, and the best thing is that Tradetron is going to allow you to reach out to Strategy One via Tradetron itself. That's probably the best way to reach out to us. While we are active on Tradetron community as well, you can reach out to us via Tradetron email and everything, and Tradetron community as well. We'll also share, our Telegram community and Twitter handles that is there in the presentation anyways, and you can reach out to us from there as well. Avinash is asking for the link for the Excel file. We'll share that, Avinash. At the end of the call, we'll try and send an email, or we'll also send, like the link on our Twitter handle, or along with the recording, we'll request Tradetron to put that link as well. Yeah. So Devinder, again, we talked about the contact details. We will have a look. We will share those. Kabir Khanna is asking for a portfolio of strategy with 15 lakhs capital deployed and diversified. What kind of return we expect? I understand no guarantees, but historical performance, what is the return that I can expect on capital? We have a portfolio which is about 15 lakhs. It has given about a 4.5 to 5% return over a period of time. This is not again any commitment, but this is what it has done on live, and we can also share that data. If I just give me 1 second, I'll try and share that data. So there is, I hope you guys can see. Yeah, so you can see this Excel, and here we have some of the sheets which is monthly returns. Yeah. So this is our combo for 15 lakhs. It has been, these are the live returns that are there, across a period, and anyone can look into these live returns, and you can understand what it is. What this combo entails is something that is there on this dashboard. You can see what this combo is talking about. This is a combination of the strategies. This is today's result, and historical results are there as well. We can always choose from these combos. Ravi is asking if deployment can start with low quantity, and if it is in profit, we can average with higher quantities. Is it the right way? Again, a very difficult question to answer, Ravi. It also depends upon your own comfort. So if your comfort into a strategy comes in only when you see profits in that, then this is the way to go about it. However, if your comfort is driven from a system trading mindset where you're trying to control your risk, so you should first look into what is the risk that you have. So if it is that you say I want to take only 1 lakh rupees of risk right now, even if your capital is 1 CR, so then you should look into it. Okay, if I have a combo of 5%, I am ready to take 1 lakh rupees of risk. So it means that I should only do 20 lakhs of allocation. So that's how we go about it, not from the saying, okay, I'll start with 1x. It should be the other way around. What is the loss that you can do? Because it might be that you have started, when the market is really good. And then when you're starting to increase your portfolio, the market turns bad. So it doesn't mean that, you will be still in profits, because when the strategy was making profits, you were at a lower base. Doesn't mean that the strategy will keep on making profit every day. It will have a period of drawdown. It will have a period of non-performance. I mean, this is something which you can see here. There have been strategies which have not performed. This strategy has not performed for a couple of months. So we have to look into an allocation rather than just looking at this thing. So sorry, I'm reading messages one by one, and because there are so many. So Nitin is asking, how can I get historical performance of Super 3 combo? So Nitin, this sheet has this historical perspective. There will be individual day-wise data as well that is available on the sheet that we have. Devinder, we'll share the Telegram link as well. So, we'll sort that out. Saurabh is asking if we have strategies for FinNifty. We have, but right now we're not talking about specific strategies. We're talking about, building a portfolio. So yes, FinNifty is also something that we can do for diversification, and we have those as well. Devinder is asking for a good strategy for a capital outlay of 15 lakhs. Again, we believe that it should be a combination of strategies rather than one strategy. You combos you would have access to, and we can discuss further. Devinder, I could not understand which slide you're talking about. So I'll come back to that part again. If you could just explain me what the slide was. Abhishek is asking if I can deploy TIDM, TDS, TMS in equal ratio for 50 lakh capital, as I don't want to have any positional in my portfolio. This should work. We'll share the percentage correlation separately with you on this. You can reach out to us on, this thing. I can't be calculating. I'm not a human computer to calculate it specifically, because the correlation is between two strategies. So what we have to do is we have to make a combination of two strategies and then correlate it with another strategy. So that's how the correlation will work. Parth is asking what is the monthly ROI and monthly and weekly ROI that you target for or have a set as a benchmark for new strategies and ideas. So, I mean, ROI is one of the parts that, people always look into first. We don't look into a strategy ROI as such. We start from what is the combination ROI we want, or combination ROI that we need to look into, and how do we achieve that? Because once if you only start looking at ROI, then you will be looking at the most riskiest of strategies. So you need to start looking at what ROI you're targeting for your combination, what risk you're targeting for your combination, and then basis that we start looking at strategies. Now there's a golden rule. Most of the times when we do intraday non-directional strategies, we're talking about 3 to 4% return on an average that happens. Now, this is a return that has happened to a lot of people, and people have seen this kind of returns sustainably, over a period of time. So that's the benchmark that is always there. And then if we can do better than that, or we can limit a drawdown from 5% to 3 or 4%, that's what we look into it. Similarly, for a position strategy, you want to have a double-digit ROI, a 10 to 15% ROI. Once we have that, then only we will look into that strategy. Of course, it might have a higher drawdown as well, and we need to understand that as part of the strategy designing. That something that can give more return will also have more drawdowns. It takes more risk as well. Anand is asking, can we find these strategies in Tradetron Marketplace? Yes, we'll share the link with you again. You can search for strategy one, something like this. You can just search for strategy one, and you should be able to find all our strategies here. All the abbreviations are there, and you can just choose the strategy basis that. Vikram is asking which combos have the best Sharpe ratio and how much is it, and the returns. So again, this is something that you will be able to get from our sheet. There is a live sheet for the combos, combo PNL, and then you can actually see all the combos, and you can see the Sharpe ratios of different combos, the drawdowns of different combos, maximum stop losses, stops, and losses and everything. So there's everything that is available, and you can look into that. So Devinder is asking capital outlay with return, where you have given the combination of two strategies. That is basically the sheet that we talk about in terms of making our own capital allocation, right? So basically, we will enter any strategy that we want here. So TDD is what we have pre-filled. We'll enter the start date. We'll enter the capital. We'll enter our multiplier that we are having. And with that, capital will be calculated. We need to enter the cumulative ROI. So here we have just basically taken it from the live data. So we need to enter the cumulative ROI. It will calculate the average monthly ROI and weekly ROI. Last month ROI is what we'll add. And then we'll also add the DD. What we'll also do is we'll also highlight which are the sections that you need to edit yourself. And that will help you in understanding what to do. And then you compare your performance with these deployment stats on a day-to-day basis. That's how you will be able to track your performance versus the strategy. So if a strategy has given extraordinary returns in a particular month, you are still looking at an average ROI. So your expectations are in check, and you are able to see how the strategy could perform. If a strategy has given extraordinary ROI in a month, next month there is a possibility that it could have a drawdown. So you will be mentally prepared for that. Saurabh is asking, can I explain the risk profile for Super 3, 5, Super 5, aggressive intraday and all-rounder portfolio? It's very difficult to put it like that. Theoretically, the simplest or the most, let's say, less risky is the intraday. So Super 3 is all intraday. When someone wants to go diversified, but does not want to go, directional, because directional, we are all, again in that, we know that direction will not happen every day, and directional can have significant drawdowns if we are against the direction. Then something like a Super 5, which has a positional, non-directional strategy, can work in. Aggressive intraday is specifically a very aggressive set of strategies which will work mostly when other non-directional strategies will not work. So when there's an extreme direction in the market, they will try and benefit from that extreme direction. And an all-rounder is basically something like a combination of directional and non-directional, positional and intraday strategies, which are uh, to most people's, let's say, risk appetite, which generally is, we've seen it as a maximum 10 to 15% of directional allocation that needs to be there. So all on PF has about 15% of directional allocation. What is the best strategy as per the present market for Bank Nifty? Devinderji, we are talking about again having a portfolio. It's not about a best strategy. It's about the portfolio. A portfolio should work, because today we can't predict the market. If we are predicting the market, we don't need to do algo trading. We would do discretionary trading and take calls and puts, or sell calls and puts, and then we'll be staying, because we know what's going to happen tomorrow. Why would we look into the market screen? We will just start at 9:15 and end at 3:30. But that's not how it is. We have to make a portfolio which will run on itself. It will try and cater to all the market scenarios that will happen, and it may fail sometime. It will exceed many times. So we need to be cognizant of that. Parth is asking, how do you manage to find liquidity in stock options? How do you do your backtest for stocks? So we don't do any backtest for stocks, or we don't do stock options. We do index options. So this is not for the purview of this discussion. I think I've been able to take all the questions right now. Any more questions, Nelson?
I guess most of the questions you have answered in detail, sir. Thank you for the session. If the viewers have any questions, you can write to us, or you can connect with Vishal sir on Twitter or his Telegram channel, as is already mentioned. If you want any such sessions at a later date, do let us know. We will make sure that we provide the webinar recording for this particular webinar on our YouTube channel, as well as the link to the Excel file that Vishal sir has mentioned. We'll make sure that we provide that to you as well. Apart from that, if there is no other question, then I think we can wind up. Vishal sir, we would like to thank you for a wonderful session once again. Really appreciate your time and contribution to our community.
Thanks a lot, Nelson. Just a couple of questions Anubrata is asking right now. Just we'll take it and we'll close it.
Sure.
Which is the oldest strategy? TDS, ZIP, and GMP are my oldest strategies. Some of the latest strategies, TAD and TIDM are latest strategies. But then that doesn't, I don't know what that tries to answer. I don't know. You were just asking, and I kind of feel very nostalgic when you talk about oldest strategies. So that's why I wanted to answer it. Thanks a lot, Nelson. Really appreciate Tradetron helping us reach out to people and explaining them the concepts related to position sizing. And have a good day, everyone. I hope you had a good week, and have a good weekend as well. Thank you.